grade 12s and welcome to our session on National Account Aggregates. Now, National Account Aggregates are going to be used in order to measure as well as compare economic growth. The methods that are used are your income, your production, as well as expenditure. Now, let's have a look at the relationship between these activities, the economic processes. Now, remember in the circular flow, the flow of production, income and expenditure takes place through the factor as well as the product market. Now, these are the three most important economic processes. The first one is total production. Remember, in order for an economy to exist, there needs to be production of goods and services, or production of raw materials into goods and services. So all these goods and services need to be calculated, and they are going to determine economic growth. The next one is the total income that is earned by different factors of production. Remember in the circular flow that the households earned an income in the form of profits, interest, rent, as well as salaries and wages. So we took all that income and we calculated it in order to get our total income. The third one is the total expenditure. This is the value of goods and services that are bought in an economy by households, businesses, as well as the government. So there's a big link between National Account Aggregates as well as the circular flow in session 1. We can clearly see that we cannot have production take place if people are not earning an income, and people are going to use this income to spend on goods and services. Therefore, we have the equation production equals income equals expenditure because of the relationship that they have with one another. Remember, production is going to take place. People are going to earn an income from this production. They are going to use their income to spend expenditure on goods and services that have been produced, and the cycle continues. So these three economic processes are going to represent the three methods of calculating the GDP as well as the main national account. Now let's look at the first one, production method. So the production method is going to add the final values of all goods and services produced. Now let's have a look at the calculation. The first thing that we're going to need in the production method is the primary sector. Your primary sector is going to involve agriculture, forestry, fishing, mining, as well as quarrying, plus your secondary sector. Your secondary sector is going to include manufacturing, electricity, gas and water, as well as construction, plus the tertiary sector, which is usually going to consist of wholesale and retail trade, catering and accommodation, transport, storage, communication, financial intermediaries, insurance, real estate, etc. The total will then equal GDP at basic prices. We're going to take the answer that we got as GDP at basic prices, and we're going to add taxes on these products. So plus taxes on products, minus subsidies on products. And why are we minusing subsidies on products? Because these are seen as cash payments to exporters, and this could also be refunds on import tariffs. So we're going to minus that. Equals GDP at market prices, and that's how we calculate the production method. Your next type of method is the income method. Now, your income method is going to measure, or the total measure of the income earned by the factors of production of GDP of a country. It's going to include rent, wages, salaries, interest, as well as profit. How do we calculate using the income method? We first start off with compensation of employees. This is in the form of gross salaries as well as wages, plus the net operating surplus. This is usually your profit that a business is going to make, plus consumption on fixed capital. This is your depreciation over time of the fixed capital that is being used will give us equals GDP at factor cost. We take that answer, we're going to add other taxes on production. This is usually tax on employment minus other subsidies on production. This subsidy is your employment subsidy equals GDP at basic prices plus taxes on products in the form of VAT minus subsidies on products. Usually these products are going to be your bread, your milk, equals GDP at market prices. Then the last type of method used to calculate GDP is the expenditure method. Now this is the total value of spending on final goods and services within the borders of a country. It's going to be calculated as follows. We're going to take our final consumption expenditure by households plus the final consumption expenditure by government plus your gross capital formation plus your residual items. These are usually your omissions and errors equals the gross domestic expenditure. We take that answer plus exports of goods and services minus the imports of goods and services will give us equals expenditure on GDP at market prices. Now let's have a look at the last one, which is your conversions. So we're converting our factor prices, our basic prices, as well as the market prices. Now taxes and subsidies are going to be the most important factors used in the conversion process. Taxes are going to include pay as you earn, as well as VAT and duties paid on imports as well as exports. So now subsidies are benefits or payments from government to businesses to assist businesses in their production process. Government gives subsidies to business for the production of certain basic products such as bread, to keep these products affordable or to reduce their prices. Government also gives subsidies to promote exports. In order to calculate basic prices from factor prices, we are going to add taxes and subtract production or subsidies on production. To calculate market prices from basic prices, we need to add taxes and subtract subsidies on products. Thanks for tuning in. Until next time. Remember guys, if you have any content related questions, you can communicate with us on the following social media platforms.